Welcome back to Communication Performance. It's been a while since I did the last video, about 2 weeks. So I'm picking up where I left off. And again, in this video, or rather this video series, I refer to it as a college video series. And in this series, what we're proving is that college students fund their own loan. And by the way, want to get in contact with me, you can contact me at contractpc7213@gmail.com. Contract PC7213@gmail.com. Right? So if you want to contact me and tell me um, how wrong I am, love to hear it. Where we left off in the last video was proving that when a bank gets a promissory note, you're basically giving the bank a payment because you are giving the bank value and consideration where they're able to increase their assets because they're not giving you anything. Because if they were, they would have to decrease their asset. And banking is primarily accounted, so all of these different transactions is reflected in the financial statements, such as the balance sheet, the cash flow statement, etc. So in this video, or in the entire video series, basically my ultimate goal is to prove that the note or the promissory note that you give the bank is payment, right? You are actually paying the bank and you are actually funding your own loan by giving the bank value and consideration on both sides of the balance sheet or their balance sheet. And as I said before, this transaction should be recorded in your balance sheet. So you should have financial records of the transaction. So you should run your um, your transaction with the bank, your interface with the bank as a business transaction. So you need to keep your balance sheet, your ledgers, and you need to record in them accurately, just as the bank do. Of course, yours will probably, I don't well, it could be a paper ledger or electronic spreadsheet. Of course, if it's electronic, you would need to be able to print that out to show as evidence as far as the transaction. So when you go into a situation that you're having controversy with anyone, specifically a bank, when they get in court, their evidence is going to be their balance sheet, or one piece of their evidence is going to be their balance sheet. And we've already discussed when the banks say that we have record of your purchases, and that's meant to intimidate you. But if you are knowledgeable, you know that by law, the bank is supposed to keep a record of all purchases that you make, right? Because they are the accountant for not only the public, but also the government. They are the country's accounting, or the country's accountants, right? Um, for lack of a better term. So under the law, they have to keep records of your purchases. So that is not evidence. That is a part of their duty. That is not evidence against you. That is a part of their duty. And of course, I also talked about in the previous videos that once you give the bank your promissory note contemporaneously, or maybe simultaneously, if that is possible, but at least contemporaneously, which means almost at the same time, you should demand that the bank give you certificate of deposit, which I'm just going to review that quickly and also review the definition of a promissory note before we jump back into Richard Werner's video. I believe it's called How Do Banks Create Money, which I've also said in the previous videos, that statement is misleading because banks don't create money, right? In the sense that it is their property because they're purchasing your loan contract or your note or whatever negotiable instrument that you have, they are purchasing it. That and they do that because that increases their assets, right? So you don't give a bank deposit, they owe you a deposit because a deposit is a record of the bank's debt to the general creditor when they purchase your promissory note on credit. And once the bank accepts that promissory note, that is the payment for the thing, right? Such as a car, right? So when we're talking about property, we have to understand the definition of property. Property is not the thing, right? Such as a car, when you go buy the car, property is the right to ownership or control of the thing, right? So you transfer your right, um, ownership or control of your the goods of your note, right? You transfer your right, but then you also gain another right, which is you have a right of action to demand that the bank pay their deposit, which is the bank's debt, right? And I believe we went over uh, at 12 USC 1813, paragraph L, a deposit is defined as basically, give you a crude definition, as the bank's debt that it owes the general creditor, which is you, the issuer of the note that the bank purchased, right? When we're talking about banking, we have to understand that banks, well, in the capacity of a bank, right, which is to get the bank is gathering um, resources, right? In the capacity of the bank, banks are not money lenders. So they don't have money sitting around waiting to lend a borrower. You are the lender. And if you don't claim your position, then they becomes, um, I guess, they become they become the lender by default because you don't understand what your power is, right? They become, I believe it's called the nominee lender, right? So they nominate themselves as lender, but you are the ones that's actually um, giving them the asset, right? And they're purchasing, they are the purchaser. They are the, if you're purchasing something, you are the borrower, right? You are the lender because you're the issuer of that instrument, and that instrument is value. And how do we know its value? Not only do we know it by the text of law, right? But it's been this way since um, the goldsmiths, right? When the gold miners was given the goldsmiths their gold, um, the bank would issue promissory notes, right? Which are promises to pay. There's no difference. Your note that you're issuing to them is also a promise to pay. And in certain capacity, you are also a bank, right? Or what um, the Public Law 73-1, um, the executive order, I can't remember the name of it, but I'll definitely make a video on Public Law 73-1, which is the Emergency Banking Act. But in Section 1, it codifies the um, presidential proclamations that were issued by Franklin D. Roosevelt in 1933. And in those proclamations, which became law under Public Law 73-1, it defines what a banking institution is. And you are included in the definition of a banking institution, right? Or rather, your persona is, right? Um, so may have to do a video on that too. So um, your persona, your representative capacity, etc. Um, when back in the day they used to refer to it as a straw man. So we are beyond. We're a bit more sophisticated. So those terms don't intimidate us, and we don't run away from them because this is how business is done, and it's in the text of the law, right? So we can actually go and quote um, the different provisions of the law that talks about the different personas, um, legal persons that you can operate or you do operate every time you act in commerce, because a bank is a fictitious entity, such as Bank of America, Wells Fargo. They are fictitious entities, they're corporations, but in law they are persons. But as a man or woman, right, from the perspective of physics, you can't make a contract, right, as a warm-blooded person with Bank of America. So you use a persona, right? And it includes when your name is put in all capital letters, right? And that is your persona. That is not actually you, but you are the representative of that persona, or you get to animate that persona. And by that way, that legal person or your legal person can make contracts with the bank, which is also a legal person, because you're not making contracts with the employees, right? So if you are saying that you're making out here as a man or woman making contract with a fictitious entity, right? We may need to do a psychological evaluation, because is based on physics, it's impossible. Based on common sense, you can't, because we're talking about in the proverbial sense, meeting of mind. So in the proverbial sense, um, corporation making a contract with a human being is not possible. So, but anyway, um, so as I said, the ultimate goal in this video series is to prove that promissory notes that you generate in commerce are valuable, right? Once the banks accept that, they are negotiable, right? And they are money. Not only, well, they are money based on Public Law 73-1. You should also read um, um, the Congressional Record of March 9, 1933, where Congress referred to notes, drafts, bills of exchange, bankers, acceptances as money. And even in antiquity, if you do your research, in many different civilizations or societies, these instruments have been used as money, right? Or they've been viewed as money substitutes, which is basically money, right? So you got to think about the fact that if we can use tobacco as money, right? Nails, shells, um, gold, even gold, which has no intrinsic value, right? The value, we put the value on those objects, right? But as I've said, human beings have value, right? And one of the value that we exhibit is our ability to not only create, but um, from um, you know, from your mental perspective and bringing it in, manifesting it, right? But also our ability to utilize our labor, right? And ultimately, the value um, in any society rests on the individual or the people's labor, right? Because from that labor comes things such as being able to generate purchasing power. Because from your labor, you can make money and then you spend, and then that generates purchasing power, right? And your labor is part of your personal um, attribute, right? It is an economic quantity that has value. And I would say that it is one of probably, it is the value because it backstops or it um, it's backing your ability to create credit, right? So when they say that banks create credit, um, that is a dangerous statement because then it takes away your power because not only the banks, but also the government borrows from the people in this particular, the way that this economy is set up, right? You do your research, you'll find out that all um, governments and banks, generally, all governments and banks around the world borrow from their people, the citizens of that country, right? Because you're the value, you create the economy, you create the purchasing power, specifically in this type of economy where the the backing of the different instruments that we use to make payments is based off of the purchasing power according to the Federal Reserve. And who develops the purchasing power? The consumers, right? But initially, you have to engage your labor, right, to be able to create, to get paid to create that purchasing power and circulate those payment instruments, right? So you generate credit, which is housed, and I'm being crude here, which is housed in your promissory note, right? And the bank purchase that promissory note on credit, and then because they are a purchaser, you're the seller or the issuer or the lender. They are the borrower, right? Because we've been miseducated, they have us thinking that we're the borrower. But all we have to do is check their balance sheet and other financial statements, and you will see that they don't give anything. And the definition of a bank is not a banker, is not to give, it's to collect, is to gather um, value and consideration, right? And they've always done this, even, um, you know, as far as going even in antiquity, even before the goldsmiths and in the days of the gold rush, right? When the gold miners would give the goldsmiths their gold to store, and then the goldsmiths started making loans based off of that gold that wasn't theirs initially, right? Well, no, it wasn't theirs, but they would make money off of it by issuing promissory notes based off of the gold back in those promissory notes. But your labor has always been there to back your credit, and you have an autonomous right to create credit, right? That goes with your right to travel, um, because we've always that's one of the ways that we create value, right? Is by exchange, right? And you exchange things based on credit, right? Your ability to say, okay, if I exchange this, then I'm going to be able to use whatever I exchange, maybe if I'm not satisfied, to get satisfaction elsewhere. And one of the best book for you to read, and I drop a lot of books, right? Because books, I get a lot of my information from um, these financial books, specifically the ones that was written in like 1800s and 1900s. You know, they were more concerned with telling you the truth, and specifically since um, only not everybody were literate, so they could tell the truth without, you know, spreading it everywhere, and it was only for certain eyes, right? So there's a book, and I highly recommend this book. Actually, it's a two-volume book, right? It's called The Theory of Credit. And the book was written by Henry Dunning MacLeod, and it's called The Theory of Credit, and it's two volumes. The first volume is is excellent. It opens up a lot of it closes the gap on a lot of things that if you study economics and you have some knowledge about finance, it helps you tremendously because it gives you definitions of words and terms that are used today in law, um, and it just opens everything up. So I will highly recommend the Theory of Credit by Henry Dunning MacLeod, and that's Dunning, and MacLeod is Macleod, and his first name is Henry. So definitely recommend that you get that, and that'll help you understand. If you read those two volumes, it'll definitely help you to understand the Public Law 73-1, the Congressional Record of March 9, 1933, Public Law 73-10. It'll help you understand the Federal Reserve Act, right? Because what I'm talking about, when I say that your note is value, it creates value, it is the foundation of our banking system, right? Your promise to pay is the foundation of the banking system. Because when even when government buy, or I'm sorry, even when the banks or the central bank, right, the Federal Reserve buy the government's bonds, that is based off of your purchasing power that makes those bonds valuable, right? And all of this is explained in Public Law 73-1 and also the Congressional Record of March 1933. But of course, you have to have some prior knowledge to be able to understand it and piece things together, right? But um, those two documents definitely explain that, well, we don't even need those two documents, but those two documents are definitely evidence explaining that the government and the bank borrows from you, right? The people, because you create the purchasing power in this economy. And the purchasing power is what's back the different instruments, right? Including credit that we use to make payments and discharge obligations. So when and we're going to get back to this video by David Werner about I believe it's called Can Banks Create Credit, or something like that. But um, he advocates that banks create credit, and a lot of economists advocates this, that banks create credit. But you have to understand, if you're coming from academia and you are a part of the club, I guess you told a lie, but to say banks create credit and not to even mention, I believe, which is the most important component of any um, economic modeling or bank modeling, is the actual issuer of the instrument that the bank purchased it from to create or increase their asset, to create the increase of their asset, right? Um, and I don't say that banks create credit, because what the bank is basically doing is just making a record of the face value of that note, which is a loan contract. And how do you create value, right? You do that by exchange, right? Because if you have gold over here and nobody wants it, then it's worthless. But once you're able to exchange it, then you're able to create value, because you come to a negotiate. You and that person that wants it are negotiating, and then whatever price point you settle on, that is the value, right? And this is the exchange, is the contract, right? No different than the promissory note that the banks get, right, on credit. They purchase it on credit, and then they say, because it is an exchange happening, they're not telling us that it is an exchange that's happening when you go get a loan, or you when the bank purchase any instrument. So banks are not deposit taking institution. They purchase your instrument. Whatever you're giving them, they purchase it. So that way they're able to create a deposit on the liability side of their balance sheet, right? Based off of double entry accounting, right? And so whatever they put on the asset side, it must equal out on the liability side. Um, and that, on the liability side, is where you're the creditor and the bank is the debtor. On the asset side, the bank is the creditor and you're the debtor, because you made a promise to pay the bank. And that instrument that you give them is payment, because how do we know it's payment? we know it's payment on multiple levels, including as it is written in the law, specifically your state law, right? Your state commercial law, or your, the more technical term is your state uniform commercial code. I recommend that you go through that, and it's title 1 through 10, right? Titles 1 through 10, and I would even go all the way up to 12. I believe it goes all the way up to 12. But the first title is the most important because that is where all the other titles extend, but specifically the definitions, right? So um, your your promissory note that you sign when you're buying a car, buying a house, whatever, um, that is based on Public Law 73-1. That is legal tender. If you read the congressional record of March 9, 1933, you'll see that they refer to it as money. And if you take the language that's in, I think it's Title 4, um, the first section, I think it's section 401. Don't quote me on that, but that particular section amended in Public Law 73-1, Title 4, the first section, 401, I believe. It amended the Federal Reserve Act. In the Federal Reserve Act, it is Section 18, Paragraph 6, right? So in that section, in the Federal Reserve Act and in the Emergency Banking Act of 1933, it tells you that the note is legal tender. Note, draft, bills of exchange, bankers' acceptances are legal tender. And you're able to confirm that in the language, which is the legal tender language that's also in, I think it's 31 USC 5103, that code for legal tender, right, in the United States Code, right? I think it's 31 USC 5103, if I'm not mistaken, and that's uh, defines what legal tender is, right? And you can look at the language, and that language in there mirrors the language that's in Section 18, Paragraph 6 of the Federal Reserve Act, and also Title 4, I believe it's Section 401 of the Emergency Banking Act of 1933, right? And then we have the Congressional Record of March 9, 1933. And then we have Public Law 73-1 that says that all coins of currencies of the United States can be used to pay public and private debt, and so on and so forth. And then you look at your state law, that's a plethora of evidence that these instruments can be used for payment and um, discharge of debt, right? Debt obligations. So I think that in the previous videos, I've proven that they are valuable to the bank. And once the banks receive them, they get an increase. They increase their assets, right? They get a sum of money or funds because a note is classified by the Federal Accounting Standards Board as cash. It's also classified as cash in the Federal Reserve Circular, right? So it's no difference than a promissory note, where the promissory note, or in this case, let's say, a Federal Reserve note, which is a promissory note, right, made legal tender. And if you look at, I think it's 8 dash, I'm sorry, Title 18, USC 8, and also 12 USC 411 and 12 USC 412. And then you add those language, right? You look at those language, and then you look at the language in the Federal Reserve Act, Section 18, Paragraph 6, and also Public Law 73-1, and in the Congressional Record of March 9, 1933. And it's beyond doubt that, and and not only that, then you look at the pattern and practice of the bank, right? And then you look at history going all the way back to antiquity, and you'll see that the notes are valuable, and specifically the laws that I mentioned, like the Federal Reserve Act, Section 18, Paragraph 6, and the Emergency Banking Act. It tells you that those notes, once the bank accept them as securities, they are legal tender, right? They are public money, right? So um, I guess this video helps me get back in the groove because it's been a while. So I'm going to end this video. And when we start the next video, we're going to review the definition of a promissory note and certificate of deposit and see how similar they are. And then we're going to jump back into the video and then start looking at other documents. So I'll see you in the next video.